The geopolitical pivot that crushed crude, a single diplomatic signal can dismantle a $50 per barrel risk premium in a matter of weeks, demonstrating the acute sensitivity of modern commodity markets to statecraft. This case study dissects the precise mechanism through which geopolitical tension, once a primary driver for a sustained oil price rally, was abruptly neutralized by a calculated diplomatic intervention.
The event underscores a fundamental shift in energy market dynamics, where virtual signaling and back-channel communications now carry as much weight as physical supply disruptions. The rapid price correction reveals that today's risk premiums are increasingly ephemeral, built on the perception of conflict rather than its material manifestation, making markets exceptionally vulnerable to political narratives.
This creates a volatile environment where billions in market capitalization can be raised overnight not by changes in fundamentals but by the nuanced language of international diplomacy.
Anatomy of a geopolitical risk premium. The premium is not a static tax but a dynamic, sentiment-driven valuation of uncertainty, highly susceptible to narrative shifts. Historically, oil price rallies driven by geopolitical risk have been sustained by a combination of tangible supply threats, inventory draws, and speculative positioning.
In the contemporary landscape, however, the proliferation of real-time information and algorithmic trading has compressed the timeline for price discovery, allowing narratives to cement and dissolve with unprecedented speed. The status quo prior to the diplomatic signal was characterized by a market pricing in a high probability of supply disruption, leading to a significant contango in futures curves and aggressive buying by commodity trading advisors CTAS and momentum funds.
The underlying driver was not an immediate physical shortage but a collective market assessment that the geopolitical standoff would inevitably impact logistics, sanctions enforcement, or production quotas. This environment creates a fragile equilibrium ripe for a catalyst that recalibrates perceived probabilities.
Signal transmission and market deconstruction. The diplomatic signal acted as a circuit breaker, flooding the market with certainty and triggering a synchronized unwinding of speculative positions. The efficacy of the signal lay in its clarity, timing, and source credibility, directly addressing the core uncertainty that had fueled the rally.
It likely involved a public-private assurance from a key state actor regarding supply security or a tacit agreement communicated through diplomatic channels, effectively guaranteeing the flow of crude. This intervention did not change the physical barrels available, but radically altered the probability distribution of a disruption event.
The market reaction was mechanistic. High-frequency trading HFD algorithms programmed to pass news sentiment initiated the first wave of selling. This was followed by a cascade as systematic funds hit their risk limits and long-only speculators began to liquidate positions to protect gains.
The rapid unpricing of the risk premium demonstrates that in digitally connected markets, geopolitical risk is often a purely financial construct, as easily removed as it was applied once the narrative of inevitability is broken.
Verdict: the new volatility paradigm. Energy markets now operate in a realm where political narrative is a primary asset class, creating both systemic risk and strategic opportunity. The event conclusively proves that energy security is increasingly defined by information security and diplomatic maneuverability, not merely spare production capacity.
The predicted consequence is a market that may exhibit shorter, sharper spikes followed by abrupt corrections, as traders become more adept at pricing and quickly exiting geopolitical narratives. Future risks include the potential for state actors to weaponize this sensitivity, using calibrated signals to manipulate prices for economic or strategic advantage.
The strategic next step for market participants is to develop analytical frameworks that decouple political theatre from genuine supply threats, investing in intelligence capabilities that gauge diplomatic intent with the same rigor applied to rig counts. For policymakers, the imperative is to understand that in the age of signal-driven markets, traditional tools of statecraft have become direct levers of financial volatility, requiring unprecedented coordination between diplomatic and economic agencies.